Right, let's now turn to a wider look at the tech space. The sector could be nearing the end of its COVID-induced overextension hangover and might be looking to return to performance-driven positive trends. Joining us with more is Erika Klauer, Technology Equity Portfolio Manager at Jennison Associates. Good to see you, Erika. So in terms of this hangover, because of COVID, because of, constrained supply chains, as we sort of see these things the wrinkles start to come out, what are you looking at in terms of your expectations for this year?
Well, thanks for having me. At Jennison, we are, I would say, cautiously optimistic. We've made our way through a lot of difficult times coming through this COVID hangover, as you mentioned. We've also seen a lot of bubbles pop with regards to things like NFTs, cryptocurrencies. Many of the valuations of the highest priced technology companies have come in significantly. So we've made our way through a lot of difficulties, and estimates have come down to more reasonable expectations. At the same time, there are still some near-term headwinds associated with things like the strong dollar and also some of the regulatory problems that we are facing with regards to shipping products to China and strained relationships with that country. Having said all of this, at Jennison, we're really looking out over the next 3 to 5 years, and we see many different large vertical markets that are still in very early innings of growth, things like 5G, autonomous driving, artificial intelligence, that we think are going to push the technology sector higher.
So let's break some of that down. Let's start with, say, the likes of Apple, bringing more of their development and design in-house. Can we expect those sort of moves as really sort of after that wake-up call about perhaps diversifying some of their supply chains when we did see the lockdowns in China and a lot of companies were like, well, what do we do now?
I think we will continue to see companies diversifying their supply chain to reduce their dependence on one single source supplier. And so for those companies that are supplying some commodities, I think that the environment will be more difficult. However, for those companies that have sole source, large barriers to entry to compete with their products, I think those companies will relatively be better positioned. Fortunately, many of those companies are US based, whether they're software companies or hardware companies. There's a lot to choose from.
I also want to talk to you. You mentioned EVs there. Obviously, Tesla has some of its own issues given what's happened with Elon Musk and Twitter. But then as we look at the performance of EVs, what do you like in that space? And which ones do you think are going to be struggling this year?
So our team at Jennison really looks to the early innings of electric vehicle adoption. And so we think that there's a long runway for growth. And I think that what we're really looking for is more the components within the electric vehicles, the semiconductors, the software suppliers that can really enable the next generation of electric vehicles and also autonomous vehicles. And at the top of that list is NVIDIA. NVIDIA's stock has come down quite a bit from its high. It's rebounded a bit as people are looking towards its dominance, not only in the artificial intelligence area, but its newer entry into enabling autonomous vehicles themselves.
And you mentioned a couple of multi-billion areas of opportunity. You mentioned autonomous driving, robotics, vehicle electrification, artificial intelligence, but also healthcare as you look longer term as well. What do you like there?
So healthcare is such an interesting area for us here. Our team at Jennison is really looking at things like the aging population and how we can service a aging population, not only in terms of within the doctor network and the hospital network, but also home health care. So digital health is something that interests us quite a bit. Companies that are enabling remote health monitoring are very, very interesting to us right now. And then, of course, within the hospital itself, robotics are coming more and more into play and providing patients with very effective treatments with a little more, with fewer human error factors.
And obviously, as these innovations continue to grow, you're going to need people working in these industries, but we're also at the same time seeing deglobalization. How is that going to impact sort of the pace of innovation and what this means for some of these tech stocks?
So that's a great question. The deglobalization is probably, in my opinion, the biggest risk to the technology sector in the short and medium term, because companies are having to not only look at their supply chain and figure out that perhaps the one area where they were manufacturing, which was the lowest cost region for them, is just not a risk properly adjusted strategy. So companies are duplicating their manufacturing efforts. And by definition, that is inflationary, and it also is disruptive. Also, at the same time of deglobalization, we're seeing many more signs, particularly in China, of companies wanting to insource, just like Apple is, more and more of their own products from domestic suppliers, from Chinese suppliers. So those are areas that are inflationary by nature, the pressure margins in the short and the medium term. So that's something that we have a very close eye to, and I think is something that's definitely worth watching.
And we certainly don't hear enough about that. So I'm glad you highlighted that. Erika Klauer, the Technology Equity Portfolio Manager at Jennison Associates. Thanks so much.